We have the opening bell here. We're below the new day opening gap, relative equal highs right here. So I'm watching that as a draw, opening range gap. We have a small little gap right there. That wick, kind of to encouragement of that, it stopped it. So that's all it technically needs to send us up into that new day opening gap again. It's still early. I don't want to try to jump ahead and anticipate everything being just straight up. For the sake of reading price action for the first few minutes, it's important for you to know that it's not necessary for you to know right away what it's going to do. Opening range gap has been priced in. There you go, you see that there. And I'd like to see it return back into the new day opening gap, not just take the gap from yesterday's settlement to today's opening at 9:30. There's your new day opening gap. So you want to screenshot that volume imbalance right here. Note that, because if it's going to pop the liquidity above here, it's reasonable to anticipate it trading up into that little volume imbalance there, the 1 minute inefficiency that's just above that short-term high. But you want to screenshot that, as I was mentioning, the wick here. Consequent encouragement of that is this. See how I hit that there? And then we didn't even touch the upper quadrant there. So it's likely that this send is going in there. Now this would have been like, say, post 9:50 if we were in the macro time and it had done that, then I would have been like, okay, it should have no problem just running directionally right into that. I want to see, when you ever hear me say that, I want to see that is not bias. That's providing a framework for Caleb when he watches the recordings, having the this gap right here. So the buy side imbalance, sell side efficiency overlaid with a new day opening gap. But you want to screenshot that wick right here and how it behaved and took us up into that. That is a very, very easy bread and butter type setup. Framing it in the context that it needs to run to a new day opening gap or a new week opening gap. That is my son's model. That's his draw. And it has to have, hopefully, something like a relative equal high, either just below it or right at it. So it's in close proximity. Ideally, the actual liquidity, if he's bullish, he's going to be looking for something that has relative equal highs below new day opening gap or a new week opening gap that he's going to be targeting as the draw on liquidity. And then vice versa. If he's going to go short, he'd be looking for relative equal lows that are just above a old new day opening gap or the present new day opening gap or new week opening gap. And they can be old as far as 5 weeks back for new week opening gaps and 5 days worth for new day opening gaps. I want to see it reach up into that daily volume imbalance. I had it divided into its quadrants. This area here, we talked about this last Tuesday, was told to you last Tuesday the market was going to go up to these levels. And we traded into it yesterday's session at the last hour of the session. And then in the London session, we had the market trade up into it here. It's the low of the daily volume imbalance that took your attention to last Tuesday and traded all the way up to the upper quadrant. Look at the bodies. It closes right on the upper quadrant and leaves this portion open. So this to me is where I want to hold my attention. I'm not trying to pick the top, and I've been maintaining that this whole series in 2024. But here we trade up into the upper quadrant, give us a reversal, trading back down into the low. There's liquidity resting below that, and you can see that we traded there and all the way down to today's new day opening gap, and this was formed yesterday. That's this reference point here. So where we settled at 5 o'clock on Monday, August 19th, and then we started trading at 6 o'clock. So that's your new day opening gap for Tuesday. That's why it's labeled the 20th, because this gap is referencing the next trading day. So you carry it forward into price action that you watch unfold, and then there's that turn at London, gyrating around towards the low. Use the low as support, rallies up, hammers it perfectly, starts to sell off, works lower, and then right down into, look at the bodies. The wicks are allowed to do the damage, but this is telling you that it's using the new day opening gap. And this is the high of that daily sell sign and balance buy sign efficiency on the daily chart. And we want to see it try to get up into above this high and try to get into this portion. That's the part that's still remaining open. So that would look like this. That high to here. Here's the low of that daily volume imbalance. Watch this gap in here with the volume imbalance between these two candles right there. So we have the low of the daily volume imbalance we talked about yesterday, and here's the lower quadrant midpoint, which in the shaded yellow area, that's the portion that has not been traded to. So we went as high as the upper quadrant here, but all of the yellow area, in my mind, I want to see, does it have the ability to try to reach for that? I'm not saying that it has to go right there right now. Technicals have to support the idea, but my initial interest today, with really nothing to speak of for the economic calendar, that for the remainder of the week, I want to see, do we trade into this area here? This little segment of price action right in here, that little segment of price action right there, that is the volume imbalance. And we divide it using this as the low, which is the open of that candle, and the close on this candle. So we're marking the difference between that close to the open of the next one. There is a wick. This wick goes as low as that right there, but we're not interested in the wick here. We're looking at the difference between the bodies here and here, because there is no connection between this candle and that candle with the body. So the only bridging or overlapping of this daily's candle to this daily's candle is the connection of the wick. And because I teach you to look at the wicks as a gap, so if that's the case, then we want to take that gap, break it into quadrants, and watch the midpoint, which is consequent encroachment. Mean threshold is a middle of a order block. Either or, if it's up close fair value gap or down close fair value gap, the midpoint of that is consequent encroachment. And wicks are classified the same way as a gap. Once you have these levels divided like that, you can anticipate what's still available. And what this is saying is this little portion of this close to that level right there. That's what's being highlighted over here on the right hand side. So that is the unfilled portion of all of this move. This blue line there, watch when I highlight it. The coordinates for that is 19,868.25. That's this candle's low. That is the 19,868.25 level. So that is the high of this civvy down to this candle's high. So between this candle's high and that candle's low, this is a sell side imbalance, buy side inefficiency. We would expect in the future the market would reach up into that level and tap it, and we're working that level now. So I want to see, do we have the ability to grind into this more and explore this area, which has not been able to book any price above the upper quadrant of this daily volume imbalance. And this was the opening range gap, and then we went above it here and we went back down into it as support, and now we're rallying up. So we want to see it eat into all of this. We want to see, does it have the strength and the ability with speed to be able to get to the lowest quadrant, which is this level here, of this daily volume imbalance, with the expectation that we're focusing on whether or not the market has an interest to get up to here. We know that there's an inefficiency still there because it's only delivered price down, but we've gone as far as this level here to the upside. So there's inefficiency between this level here on the left to here with buy side delivery, meaning all we're saying in simplest terms is we're expecting the market to go up in here and just offer price at these levels. That's what we would anticipate as a realistic, it's practical, that it's gone as far as here. So if it's bullish, it's reasonable to anticipate it reaching into here. It need not do it today. Watch this one in here. Now, if you look at it over here on the 1 minute chart, we had this fair value gap there. And I like the fact that this gap occurs and forms on the 15-second chart. I see it forming on the upper half of this gap. This fair value gap here, if it's going to be the ideal scenario, it would be being sensitive at the high end of it. In other words, half of it. The best formations or continuation would occur where price only going into the upper half, not digging down into the bottom half. But can it do it? Yes. If it leaves it open, it's indicating that it's extremely strong and it should keep pressing higher. But if it's going to go down, what keeps it still germane to the idea that we would stick to reaching for this lower quadrant and measure it? Does it have the ability to get there? Number one. Two, how fast does it get there? And once it gets to that level, how does it behave? Does it hit it and fall short of going any further? Or does it go through it like a hot knife through butter and just slice right on through and reach for the midpoint, which is this level here? So we hit the upper quadrant, but it hit the consequent approach of that wick. It's perfect delivery. So if you have that and you run up to this quadrant here, you want to screenshot that. And you're seeing the measurement of real order flow. It should behave in a manner that supports price, repricing down to inefficiencies, using the 1 minute chart to the left and carrying it over to the 15-second here. So what I'm doing is I'm constantly balancing the effects of where price should gravitate to, where it should support price, where it's allowed to do the damage. If you look at what was shown here, I was outlining the fair value gap with the focus on that lower quadrant level right there. So we were looking initially at this gap here. We went outside of it a little bit, and where to go? Just to the low of the new day opening gap and stopped dead in its tracks and rallied up. Spent a little bit of time, and the bodies were telling you what it wants to do. It's going to want to rally. It rallies. It gives you displacement with the 1 minute chart here. So there's a gap. So that gap is real in this range from that candle's high and that candle's low. But over here on the 15-second, I took your attention there. Look where the bodies of the candles in the 15-second stop and stay inside of. It respects its fair value gap that's in the blue. You see that? Look at that. Look at that body right there. The wick is only afforded to go as low as what this 1 minute fair value gap does, and as low as the consequent encroachment of this wick. Why am I picking this wick? Because it's the highest. Going to the left, it went above this one. There's the trade to consequent encroachment right here. So now we want to see, does it have the ability to get to the upper quadrant? So if I measure this again, from here to here, that's perfect delivery. So when you're watching things, if it's going to go up, you want to be measuring as I'm teaching you here. This is the price delivery continuum theory. It's my way of reading real order flow. What I'm doing is I'm getting a measurement. Do we see things in price action that are going to support the algorithm repricing back to these reference points like we have here? And then does it deliver higher? Yes. Does it go to the level here, which is the lowest quadrant? Yes. And then once we got there, did it show a willingness to want to trade to consequent encroachment, which is this next level here? It trades right to it. Now we went to this objective. As we hit that, you want to screenshot all of this. You want to have all of these reference points shown. All you're doing is framing, okay, the market has proven it gapped lower. Then we overtook that gap. We traded above, used a new day opening gap here, touched the high of the opening gap here, rallied, and then we got this fair value gap given to you on a 15-second chart, but allowing you to use as much as a wick coming down to fill in this 1 minute fair value gap. But using the wicks as I've been teaching you, the consequent encroachment of that wick here is exactly that low. So there's no reason for you to be panicked. All you're doing is relaxing and looking for the things that I'm teaching you exist in price. All we're saying is there's a big magnet that is luring price up to these levels because there's an inefficiency. It's lacking movement up into these levels. It's not important for you to pick the determination of it getting to just a halfway point. It needs to just touch the low of it. And then you watch and see, does it have the ability to aggressively run into the halfway point? It's still there. This portion is still open and exposed to inefficiency because it's lacking candlesticks offering price as it passes through the low end of that yellow shaded area to the high end of it. By seeing these points of reference and watching how price delivers over a 1 minute chart and a 15-second chart, when you screenshot this and it hits these levels here, and then because we took this high out here, every time you're holding an idea that it wants to go higher and you're trading on that idea, if you have a short-term high and it reaches to a level and it goes above it, you need to be taking some kind of a partial above that. Because if you don't do that, you're going to miss the opportunity of distributing at premium level prices. And we went all the way back down into that fair value gap here on the 15-second chart and the 1 minute chart. Is it done all the way down here? Is it completely said, I'm not going to go any higher? You wait and see. You don't know. When it created this short-term high here and trades above it, if you have the ability to take partials off, you take a partial there. So it's important to know how to run down equity, which is what I call it when we're in a buy program and we're looking for targets to be reached. Anytime it creates a short-term high and then breaks above that short-term high and you have the ability to take a partial, you should, because it will reward you for holding on to the trade. It's a logical level to take a partial. Go into your notes, okay? When you're long, every short-term high that is broken, that is a candidate for you to take a partial. It's better for you to take a partial than it is for you to move your stop loss. It's real important for you not to try to move your stop loss in the early stages of your development, but the only thing you're actually doing is you're increasing the level of uncertainty, anxiety, and you're going to be worrying about your stop loss getting hit versus watching and studying price. We fell just short of the upper third quadrant. We swept the high here with that high, and then slipped back down into the 1 minute buy side and balance sell sign efficiency, that fair value gap, and then touched that 15-second fair value gap there right to the tick. And now we're just banging around between the lower quadrant of that daily volume imbalance, that shaded area here. It's in pink. It goes as high as this, but there's been an opportunity here this morning for you to screenshot where setups were formed using the gap closure here, trading above, come back down, use the gap as support. This opening range gap, that range, you want to keep it on your chart. Extend it throughout the day because it will use those levels, the high, the low, and its quadrant levels. They will be used over and over and over again. Every time price is allowed to trade through it and back to it, they'll reference it. The algorithm will refer back to those levels again. But we want to see days do these types of things where if we expect prices to trade higher, we want to see the opening range gap. If it gaps lower, that's to entice traders to be short. Then you see the gap fill, which is generally what you expect to see. At the very minimum, highest probability is if you get a gap lower opening, mark out 50% of that. Because if you can capture that as a run on price, you can do a lot of bread butter trade setups like that and have no bias. You don't even need to be right on the bias because there's such a high degree of the market returning back to the middle of the gap. If there's a large gap down like that, mark out the midpoint. And then wherever that midpoint is, where we opened, it's going to gravitate to that. Even if it goes lower, it's going to go back to that midpoint. I promise you that is one of the surest things in trading. It's really strong. If the gap can close and we're bullish, we want to see it leave the gap like it does here and then come back down. Look at the bodies stopping right at the high opening range gap. It's stopping. The wicks are going inside. This body opens and then we send it back above. What's in close proximity to the high end of that opening range gap? It's the new day opening gap for today. Well, we're working off that. This candlestick comes right down to the low of it and sends us again higher. We were using the reference points on the 1 minute chart here. Came down, we saw the wick come down to the consequent correction of this highest wick here, midpoint of that. So if it's going to overshoot this fair value gap, you can determine just how far it can do that. If you watched what I was doing in recorded sessions, and I'd say, okay, what you just saw was a MOHAWK where it just goes just outside the fair value gap. That's permissible price action. Well, it needs to occur with things like this where we can measure it. And so by having these wicks, or if there was a larger inefficiency that I wanted to trade down into, that's what makes me confident when I'm saying this is going to be a MOHAWK. But when we start seeing these things and it starts promoting higher prices, we each time measure what the lower time frame, like all of this in here, reaching up to lower quadrant, midpoint, we rally a little bit, but then we have these tiny little fleeting attempts to try to get up to where we're aiming for. And then we slip lower, sell side, went down, we cross back over top the new day opening gap. We're inside of that opening range gap again. So there's a quadrant inside of that opening range gap, but you want to have these levels on your chart while you're screen capturing and logging. Do we come back out of the shaded area here in gray, which is the opening range gap? And if we do, does it react off the new day opening gap? This is the next draw. If it wants to retrace, we have a sell side imbalance, buy side inefficiency here, which is overlapping with the new day opening gap. So we have low of day liquidity resting right below here. And then inside that, we have all these little pockets of inefficiency and relative equal lows right here. So we have a little bit of sell side there after we had that big pump up in the last 15 minutes or so of the day session yesterday. We gapped down, pumped it up one more time. That inefficiency that's remaining above here, that has been placed on the back burner for right now. And we're studying how we're behaving inside of that opening range. We rallied up, we worked the top of that opening range gap here and touched what level? The new day opening gap low. And now we want to see it work below this low here and probe and see what any interest at all below that after that sell side's engaged. If you look at what we were outlining over here, how we were running up to the lower quadrant, and then reaching up to this level here. All of this is distribution around the target we are looking for, which is midpoint of the volume bounce on the daily chart, which is that low to that high. Then it slipped lower. By having partials taken off here, it doesn't matter if it does this because Caleb would have already booked profit up here at the premium levels near the highs. We've already tapped that low. We want to see a little bit of expansion in here, see if it has any interest to dig down in, make an attempt to get down below yesterday's afternoon session rally here. The graduated example of going in, having a model, reaching for a target, but not requiring that target to be hit to be finding profitable exits for your trades. That's a huge paradigm shift when you can take your time and spend it more economically. So that way you're not in a state of panic or fear while you're engaging price. When it's disarming and relaxed like we're doing here, it frees you up to watch what price is doing, so that way you can recognize certain aspects of in pattern formation, so that way it leads to pattern recognition, because repetition will provide the recognition. I mentioned how when we opened down here and we had the gap, as soon as you see where we settled yesterday and you're watching real-time price action before I actually got on the live stream, you knew we were going to open lower than that. So you wait for the first tick. As soon as you drop your fib on that, you know that 834 is midpoint. So you could look for a retracement right in there. And I've done many times this very trade where I don't even look for anything except for as soon as it starts opening and trading, if I have range between where it's at when I first see it and where the midpoint of the gap is, I'll go long right there. Most of you would be scared shitless to do that. But I know that this math that is always likely to see that midpoint gap traded to. Because if it's going to go lower, if it's going to go lower, it's going to do this. Halfway, then drop. Or halfway, a little bit more, failure to close in, then drop. But if it's going to be bullish and we're expecting things up here, as outlined yesterday and last Tuesday, then means that we're anticipating the likelihood that it wants to go above the gap. And then when we see that, then it touches it here. So a gap is going to be used as a future point of reference for the algo to start keying off of and start spooling. So if it's bullish, higher time frame, and we're expecting higher prices, and we have something up here that needs to be revisit it in a perfect world for efficiency, then this is going to act just like an old fair value gap. It's going to find support there. And do we see signatures that support that? Yes, the bodies are saying, I'm not interested in going back down in there, even though we had Wicks doing it. And then we see price displace again, and it supports around what? The new day opening gap. And you see that element of price delivery over here. Meandering around, displacement, dropping back down, perfect delivery to new day opening gap, rally. Fair value gap, boom. That right there is institutional order flow entry drill. Here's your fair value gap. All you gotta do is use that candlestick plus 1 tick. You would be filled there. Rallies. This is the high watermark of the daily sell side imbalance, buy side inefficiency, where the gap is on the daily chart. That was your first objective before you get to the volume imbalance, which is that pink shaded area here. And then we rallied up, hit that low, dug in, back down in, order block there. Rallies. Almost immediate rebalance on that candlestick. I would have expected that to happen. It didn't deliver there. That's fine. The fact that it didn't do it, is that good or bad? It's good. That means it left a portion open. So what's going to reach for it? That lower quadrant we were aiming for. Does it have the ability to trade there? Does it do it with speed? Yes. Then if it does, and it has those things, if it has speed, if it has a real desire to get there, that means then we should have no problem getting to the midpoint, which is there. And what does it do? It trades right to it. We have a little bit of retracement, then pump it up one more time. Short-term high after the target's being reached. Every milestone by having predetermined levels of what you think is a minor target. Minor targets are initial candidates. If it can trade there and you can afford yourself a partial, you'd be doing it anyway. Here, if you didn't take a partial here and it rallies above that short-term high, you better be taking something off, because in your limited experience, you're not going to know when it's going to do things like this. And if you don't take the partial profits, you're going to be seeing a winning trade turn against you. Taking partials is a professional mindset. And what matters more, being right or constantly making fucking money? Constantly making fucking money. I teach my students, and I'm teaching my children, to think about taking partials before moving your stop loss. Because number one, it rewards you for doing the right things. You've held on to the trade to that point. You have a profitable partial. That means if you put your stop loss to cover costs at that point, theoretically, you don't have any chance of losing money. That's a huge paradigm shift for someone that's developing as a trader. So there's a little bit of a spike below that. So I want to see, do we maintain that or come right back up in the range between this high and what we've seen here by taking the liquidity below there? That was a little too shallow. I like that run there. That was a little bit better. So if we start losing some ground below here, we might be interested in seeing this area over here, because it's a lot of liquidity resting there. I like the idea of still getting up here. That may demand an afternoon or tomorrow framework to do that. I don't know what we're going to see in an afternoon right now based on what we're seeing, because it's a rather quiet news day. I'm not abandoning, let's say it that way. I'm not abandoning trading up into here for today. I think that there's a lot of buy side resting here. They set a lot of folks in motion that maybe we top, and the liquidity sitting right here, and that buy side, everything that was outlined all through here with the 15-second and 1-minute chart PD arrays. Go back and look at your charts and your examples of when you would expect a certain level to be draw on liquidity. Again, as a reminder in closing, you do not need that draw on liquidity to be reached by price. Success is measured by where you can see a beginning point where price can move from up to that terminus. And if you can frame a setup that allows you to have 15, 20 handles, then in my definition, that is a high probability likelihood that Caleb can take that trade. So it's not a guarantee you're going to be profitable in it, but it's a green light that you can take it. And all you do is simply look for inefficiencies, because his model is gaps. And he's looking for inefficiencies in price action, gravitating and keying off of new day opening gaps, new week opening gaps, and bringing in the higher time frame as we were talking about yesterday. Focus right here going into lunch, okay?